Unlike the dot-com crash of 2000, where the market was largely blind to the coming burst, today's investors are fully aware they are walking into a massive AI bubble, yet they continue to sprint directly toward the precipice. They're doing this despite the baseline financial reality of the AI boom. The core product is highly unprofitable. Companies like OpenAI are selling access to services that cost them significantly more in pure computing power than they ever bring in from sales. This chart compares combined cash reserves of the top 7 tech giants to their projected AI capital expenditures this year. They hold an astronomical $600 billion in the bank, but they are projected to burn through $725 billion just on AI infrastructure. The math is unforgiving. Even the deepest corporate war chests on Earth cannot sustain this burn rate, forcing historically profitable companies to bleed cash just to stay on the playing field. Trapped in a prisoner's dilemma, if one company secretly develops a super intelligent model, they win the market. If a company opts out, capital flees and their stock crashes. This fear ensures mutual resource depletion. Every competitor is forced to aggressively burn capital simultaneously. Meta illustrates this forced commitment. Their leadership has publicly admitted they must commit hundreds of billions of dollars to AI simply to avoid looking like they are surrendering to their competitors. With their massive cash reserves drying up, these tech giants have pivoted. They have doubled their debt loads, borrowing heavily while the Federal Reserve holds borrowing costs at peak levels. These companies are now locked into a high-stakes debt cycle. If they stop spending today, the tens of billions they have already burned are entirely wasted. There is a specific reason why the most profitable tech empires in history would willingly accept corporate interest rates between 6 and 12%. The answer lies in how the corporate tax system is structured. This visual ledger demonstrates how corporate debt functions as a tax shield. If a company makes $1 million in profit, but takes out a massive loan requiring $650,000 in annual interest, they can deduct that interest directly from their operating income. Then they exploit the hardware loophole. Taking that borrowed capital to purchase AI chips creates an immediate equipment write-off. Applying that remaining $350,000 to hardware zeroes out their taxable income. A massive portion of this trillion-dollar AI infrastructure build-out is being subsidized by tax loopholes, which encourages tech giants to take on even more debt to lower their tax bills. Wall Street has capitalized on this demand for capital. Private equity firms are raising billions to buy AI chips, leasing them to startups at a massive markup, and quietly pocketing the risk-free yield spread. But the private equity firms don't hold the actual risk. They package this high-interest corporate debt and sell it to pension funds and retirement accounts, shifting the potential for default directly onto the public. Tech executives take advantage of this dynamic to authorize massive stock buybacks and rush their debt-heavy companies onto public indices while market enthusiasm remains at these record highs. Surviving a rigged, highly volatile environment requires a mathematical risk-to-reward strategy. You cannot rely on generic stock tips or chase the same hype everyone else is seeing. You have to approach the market with the discipline of a guerrilla trader. By maintaining a strict margin of safety, you can lose small amounts of money on 4 separate trades and let a single calculated win cover those losses to deliver a massive net profit. That structured approach is exactly what we teach in the SFA Free Stock Investment Masterclass. To learn how to actively protect your capital, click the link in the description below and claim your free spot today. When you compare this to history, the 2000 dot-com crash was an equity bubble that bankrupted individual companies. Today's securitized AI debt is embedded in global institutions, echoing the structural vulnerabilities that defined the 2008 housing crash. There are 2 distinct paths ahead. If the Federal Reserve aggressively cuts interest rates, these tech giants will simply refinance their expensive debt, delaying the pressure while growing the debt bubble to a much larger scale. If rates stay high, the debt will eventually buckle. We are seeing the warning signs. S&P recently downgraded Oracle to the brink of junk status due to massive debt and negative cash flows. A liquidity crisis at that level creates the potential for a broad credit freeze. The sheer volume of these AI-backed debts, now sitting inside the portfolios of global banks and public pension funds, ties the stability of the tech sector directly to the retirement accounts of millions of people. The ultimate impact of AI on the world is secondary to the immediate financial viability of the companies building it. Even with world-changing technology, if these companies cannot generate direct, highly profitable cash flow to service their massive debt loads, the bubble will burst. The time to rely on passive optimism has passed. You must move away from the hype cycle and start taking active control of your financial planning before these systemic debts face a reckoning. Thank you for watching the Stewardship Finance Academy. Please share this video with your family and friends so they understand the risks in the market today, and we wish you safety and clarity on your path to financial freedom.